Rob's child. Nothing I say is investment advice. I have no intention to replace any content of security analysis, but to open the content up for discussion. This episode is on Chapter 43, the significance of the current asset value. I found at the beginning of this chapter point 2 and 3, or thesis 2 and 3, fairly funny. And I'll just read them to you, and I quote, "A large number of common stocks sell for less than their current asset value and therefore sell below the amount realizable in liquidation." I found that funny because it seems like an obvious thing that people could take advantage of right from the beginning reading this chapter. And then number 3 is he talks about there's a phenomenon of many stocks selling persistently below their liquidating value and how it's fundamentally illogical. And so he says there's either, it means a serious error is being committed either by the judgment of the stock market, in the policies of the company's management, or in the attitude of the stockholders toward their property. So that's this whole chapter in a nutshell. I'm not sure if there is or not a valid argument to be made against what he says, simply because, as a stockholder, you don't really necessarily really feel in control of the company that you supposedly own, because you don't have direct control over it yourself. You can't go to the company and say, hey, you have more cash, minus your liabilities. You have more cash right now available than my portion of the company. So, and my portion right now on the open market's selling for less than that, and so give me my money. I'm gonna sell you my shares, and so you can't really do that. And I think that might be an argument against what he says, but let's just go through the points. It's a number of very good points he makes throughout this chapter. The first point that we're going to discuss is that he brings up, and that's the first little subtitle, is liquidating value, and going over the fact that liabilities are real, that when a company owes a certain amount of money, this is a straight number, this is what they owe, straight. There's no way to misinterpret that. However, when it comes to assets, the supposed asset value of everything the company has, that can have items in it that are up for debate. And he has a little chart here on 579 going through that. Obviously, cash assets, including, I think a lot of companies have their cash in cash equivalents, which are generally like treasury bills. And he says you can account that, that's 100. You can count 100% of that is definitely actually part of the real assets of the company. And then, he has a normal range with a rough average of other items that can be considered to be assets. One that I found, the one most interesting I found was fixed and miscellaneous assets, being real estate, buildings, machinery, etc. He says the range can be from 1 to 50%. And so when a company is claiming that they have real estate worth $1 million, you should count it as $500,000 at the maximum. And he says average, you should only count 15% of this as being the real actual liquidating value. I found that to be pretty fascinating, really. I've always kind of thought that way myself before reading this, when I'm taking a look at the supposed assets that a company has, and Graham apparently I have already agreed with Graham in the past when I'm looking at a balance sheet and I look at the current assets, I see, okay, cash and cash equivalents. What do they actually have right now? And apparently at the end of the day, he says that this is a great metric to consider for that number itself to be the liquidating value of your stock. So I found that to be very interesting, and I don't know how that all works out. Like, if the tangible assets, for example, are typically outweigh all of the liabilities, and then the current assets are typically worth the stock holdings. That's what I gather from this. He didn't go into that very deeply, but there was, with using the example of White Motor, he goes through the different numbers and concludes, especially with this one, that, current assets give a rough estimate as to liquidating value. And with White Motor, they had cash minus all liabilities was actually much higher than the stock price, and that was one of those things that you could scoop up and sort of have a quasi arbitrage situation. And so that's what this chapter is all about, is finding companies that are in that situation. He says that it's surprising how often that really happens. I don't know how often, if that is still happening today. I feel like I have remembered doing this exact calculation in my head, looking at certain companies, and seeing, and all you have to do is look at the market cap, which is the total value of the stock, and compare it to current assets, cash equivalents. And if the cash equivalents is like, and then minus liabilities. So if you minus liabilities from that, it's like extremely clear that that company is worth a lot more than the current stock price. Now, point he brings up here, next point I wanted to talk about was that how common this was, and that even during the mania stock phase from 1927 to 1929, he says it was not rare to find some common stocks below their liquidating value, even during that period. But it was as high as apparently 40% of industrial stocks from deep in the Depression, 1931 to 1933. At some point, there was a study done, I guess, that showed that 40% of industrial stocks were in that category, which is a lot. And then again, in 1937 to 1938, 20% of industrial stocks had hit that point. But he also mentions that differently in 1921, there wasn't that many in that kind of category. I have my doubts there's a lot of these kinds of things available today, but who knows? Maybe you know. Comment below. So companies that are in the situation where they're clearly worth, where the market value is less than the liquidating value, he says essentially, there's only two. He's very confused about this, writing through here. But he says basically, you're either dumb, or you're just convinced that the company is going to lose all your money and they're just going to refuse to liquidate. And like I said at the beginning of this video, you can imagine, you're sitting holding this stock, and you can't force the company. You can vote, with all the other shareholders to do your bidding, but you don't have direct control especially as a smaller shareholder. And I think he kind of ignores that point a little bit too much, personally. But I am not Graham. I don't know. I wanted to add there too is that I think another reason that this can happen is forced selling. So if you have, and especially like, during the Depression, if you were a person that had a stock that had lost value, but you need that money to be able to buy groceries, to be able to, afford your debts, there is such thing as forced liquidation of assets. And I think that sometimes that can be a factor when you encounter these kinds of situations, but he doesn't mention that in the book. And then he kind of repeats, if you're holding stock that's clearly below its liquidating value, this is not a smart thing for you to do to sell it. What you should do is, put your vote in to liquidate it in this kind of situation. Obviously, that would be to your benefit. Granted, if that amount, it's more than what's currently worth, but maybe it's more than what you paid for it, so you're feeling... he doesn't get into some of the other... he's just stuck on this one train of thought throughout this whole chapter. It's kind of funny. But again, there's good points to get out of this. And one of the good reasons he says, to basically, don't sell in this situation is that, he goes through a number of examples where the shareholders were greatly rewarded. They held on to their shares, and the company eventually fixed what was going on in various ways. But there's a note before I get into that section that something that can cause this to happen in the first place is if you see earnings declining and declining and declining and declining, it can scare away shareholders. And that it is possible for a company to, burn through all of its current assets, all of its cash, before you're able to do anything. But he doesn't seem as concerned with that. Usually a company, assuming that the management isn't completely evil and terrible, it will be a situation that's rectified before, the liquidating value actually drops to the current market value that was previously depressed. But yeah, so the part of ways that a company can or should deal with a situation like this is either just wait for the industry to heal, to get better, so that your earnings grow. All of a sudden, the capital value of the stock, at least intrinsically, will go up a lot. Or for the company to improve what it's doing. So if it's selling something if blue shoes are really popular and they're only selling blue shoes, and then all of a sudden no one wants blue shoes anymore, they're buying purple shoes, maybe the company should start making purple shoes, that kind of a thing. Or, have themselves be in a position to make themselves attractive for an acquisition. And a lot of companies will do this, even not in this specific situation, by merger or acquisition. Or, you don't even have to necessarily liquidate the whole company. You can liquidate part of the company, and just have a special dividend distribution. And I've seen that happen before in various companies. And, he is in support of that. And then, so then he goes over examples of companies doing those exact things. One thing he leaves out in this section is buybacks. Think about it. If they have cash, it would be obvious to me that it would be in the shareholders' best interest for the company to be scooping up as much of its own shares as possible. Spend all of the cash on buying up the shares. Get rid of all of the people selling the shares, at this stupidly low price and reward generously that rewards very generously the current shareholders. He doesn't mention that, but as a way of doing it later in the chapter, he sort of alludes to it, but that's another obvious solution to me. Then again, maybe that's part of what he's talking about, special dividend, because like earlier in the book, he sees share dividend basically equal to a cash dividend, which it sort of works a little differently today, as I've talked about in previous videos. So this whole section overall seems to me that he's basically demonstrating huge opportunities for people looking for dirt cheap stocks. It's just like yeah. So and then in this part he says, so in the case if it is likely that one of these things will happen soon. And then we have a point made that we should avoid it if current assets have been declining a lot, and has two examples of where one company's, I think it was their cash assets had actually grown, but their total assets had decreased, and compared to another company where their total assets decreased and their cash assets decreased. And he said, basically look out for companies that are just burning through cash. I think the main point here is just be careful of companies that are just burning away the cash that's available. That's not a good situation to be in. Again, correct me in the comments below if there's any errors here, but I think that's the main big point of that. And then on 589 at the bottom, he has 3 rules for these types that essentially, so the 3 rules are selling below their liquid asset value. There's no apparent danger of dissipating these assets, and that they formerly shown a large earning power on the market price. And so and that's how you get an investment bargain. And so that looking at, I'm glad he mentioned that, because some uranium explorers never have showed that some of them arguably could be in this situation, but they've never shown any earnings. And so for him, that doesn't actually fit this category. I was thinking maybe they did until I read that. Then we move on to discuss how the whole market, like the whole stock market, what's going on, and how it can actually be problematic if the stock market seems too expensive or too cheap to be looking for these kinds of opportunities. He says you basically wait till things are like normal before you look at trying to achieve this. And he says, because if everything is expensive, even though it's below liquidating value, it can drop further in value. And then, that's not a good situation for you. I found that to be very, very interesting, a very, very interesting perspective. I'm assuming a small part of this is the tangible asset value from an expensive market to a more depressed or normalized market. That value drop is going to be pretty intense. And then on top of that, the way of coming out of that is going to be harder, going from an expensive environment down to a lower environment. of value. So he says avoid it when everything's expensive, and also avoid it when everything's too cheap. Well, not necessarily avoid it. You just have to realize that it can be just attractive to buy stocks that are that haven't suffered a decline in price like this before. If everything's cheap, you might as well get something that is maybe has a little bit more safety. Even though these types can relatively get down to even a cheaper level. And I found that to be surprising. I don't actually fully understand why you wouldn't want to take even more advantage of a situation like that in super depressed markets. Again, this may just pay tribute to a little bit of my confusion on some of his perspectives on this. And, mainly as I've said, the idea that as a shareholder you don't have immediate direct control, and I think that's worth more money than what Graham is giving here. So again, it's best to try to find situations like this when markets are normal. Now, we have a situation on page 590 and 591, and I'm going to try to simplify what he says here, and I think that this he uses a real example, and it gets a little complicated. But I think in a nutshell, the way this works is if you have two equal companies, A and B, A has no bonds, it's just stock. B, let's say, is capitalized with 90% stock and 10% bonds, then the stock value of company A cannot possibly be worth less than the bond value of company B. Point being is that, when you're seeing examples like this come up, you do see this. You see the stock value dropping below what would be even considered to be like the bond value of a company. All right, and then the chapter finishes with, he quotes the last few paragraphs from the 1934 edition that he's very angry when he's writing this part, I think, by the way by his wording. It's kind of funny. But he says basically, dividends don't make common stock safer. Money put in a treasury instead of being paid out to the shareholders is still property of the shareholders. However, investors will dump shares if it's not paying out its dividend. And I mean, part of this today is this is a concern, and you see companies paying dividends they actually can't afford in a lot of cases. And I believe today part of the problem is that you have a lot of funds or indexes that are rules-based, and that if you were to drop a dividend, then you get dropped from the index, and all of a sudden your stock price is going to be plummeting because of the fact that you didn't pay that dividend. There's no mention, that's not a part of this chapter at all, but that I would personally say is a big modern problem where dividends sort of make the common stock more safer in that regard. However, intrinsically, it doesn't, directly. Again, when your stock price goes down enough, it can lower your credit. It can cause the company some problems. And he doesn't go into any of those details here in this chapter anyway. But yeah, to finish, he uses an example to basically call Wall Street. He uses the word idiocy. It's idiocy to sell stock in the case of not getting a dividend, especially all while being happy. Wall Street is perfectly happy having the bonds of the same company, and the main point being that if you believe in the safety of the bonds, you know, don't get your panties in a bunch when it comes to the stock. And that's all I have for chapter 43 of security analysis. Hope you enjoyed. Discuss in the comments below. Rob's Child.